Welcome to the Daily Update. This is Being Prepared Tuesday, March 29th, where we'll look at the action in the market today and then see how things look for Wednesday, March 3rd. It was a pretty positive day. We saw some breakouts. Our technicals are looking pretty strong right now, although we are hitting some overbought levels. And it looks like we're getting to the point where a lot of investors are starting to accept this rally, which might sound kind of good. And we might go higher from here, at least in the short term. But when everybody starts to jump on board, that's when we start to get suspicious of this. Now, I don't mean everybody. There are still some people that are suspicious of it, but it's like, it can't go higher. It can't go higher. And then it does. And so when they finally give in and say, yeah, I guess it's going to go higher, that's almost capitulation to the upside. And we just need to be aware of that. So let's go back over Tuesday and see what happened. We had a real gap higher at the open. We gapped above R2, and there was some selling into strength. We bounced around a little bit. We went between R2 and R1, and we were kind of in that range for most of the day. And what I see is a little more positive. If you see buying later in the day, that's the professionals coming in and taking over and do what they do. And that's why I say it's amateurs who open the market. It's the professionals who close the market. And so if I'm looking to initiate any long positions in this current environment, I'm not really messing around too much with the open. I might use it to close out a position if my targets are met. If it's a gap in my favor, that can be very rewarding. What I'm talking about is when you're initiating new positions, especially long positions, I like to wait until as far as I can into the trading day, if not as close to the close as possible. Now, some of you may not agree with that. You're like, wait a minute, it's an up day. You get in at the open, you get to enjoy the benefits of the move for that day. And I can understand that. But at the same time, how many times have you seen a real strong open and then we start seeing some selling, they come down and they fill the gap, only to have it keep going after that? And now right off the bat, instead of being in an offensive position thinking, okay, this is a long position, it's going to go higher, now you're seeing a losing position right off the bat, and that can be real disheartening. That's just been my experience. Just don't be afraid to wait most times until we get further into the day, if not close to the close. Now, if you're doing time-based positions where you're using theta and time decay and everything to help profit from that position, that's another thing. Those kind of positions, I tend to get filled whenever they'll get filled, because you're doing option spreads and sometimes like iron condors, where you're trying to get all of that in or get all of that out as one unit. We have to look at things a slightly different way at that time. But if you're just going strictly long or strictly short in a trend type of strategy, then we look closer to the close. At least that's what I do. And that's what I teach in the program that I have. Anyway, it was more encouraging, though, as the day went on and we saw some late day buying, and it actually took us above R2. I calculated R3, but we were pretty far away from that, so I didn't draw that on the chart. And we closed right near the high for that session. That's also pretty positive. We ended up being up 1.23% on the day. We did see an increase in volume, which that's encouraging when you compare to the last 7 trading days or so, because we were much higher in volume looking back just that far. But if you go with an average volume, we're still below average at this point. The technicals are looking pretty strong right now, but we're also getting overbought and maybe too much of an acceptance that prices are going to go higher. We need that disbelief in there, at least to a certain degree, that tends to work more in our favor. We're getting near the end of earnings season. Inflation is what everybody's talking about. Interest rates are a big deal right now, which kind of goes into my last point here, where I did a video on Tuesday about the yield curve, and it's what I call a supplemental video. Usually I record daily videos, weekly, monthly, and then I have the courses that I also record. Well, I also record a series of supplemental videos, and this is kind of on an as needed basis. If something's happening and I think it might be worthy of people hearing about, even if other people are talking about it, I still have my own way of presenting things. I'll go ahead and do a supplemental video. Well, we've been hearing a lot about this inverted yield curve. And so I went ahead and did a separate video that's freely available on YouTube and Rumble, if you would like to go watch that. The geopolitical concerns, they seem to be a little bit more positive right now. There are some talks going on. There's some different compromises and things that, are going back and forth. And the markets, anyway, are taking that as a little more positive currently. So what are some comments? We are out of correction territory. In fact, we're not too far from actually getting back to the all-time high. Are we going to get there or not? That's yet to be seen, but things are looking positive, at least right now. The technicals are positive and keep improving with each up day. We could even have a slightly sideways to down day and still not really damage the technicals. It's what are we going to see if prices really start to head lower? Are we going to see a pickup in volume? Are we going to see some damage done to our technical indicators? That's when we might look at it in a different way. But to go sideways, slightly down, slightly up, and chop for a little bit would not necessarily do a lot of damage at this point. Prices still remain in that range, even though we're breaking out of that range now. We were able to close above that short-term double top that I've been talking about for a long time. And that is quite positive. That was really producing some problems. And I think that's what might make people that follow the market more closely, that may help them to say, okay, maybe this is for real. We got back to that double top and just shot right through it and then closed above it as well. Okay, now I'm willing to go long. So that's one thing, just have that in your mind. With the Russia-Ukraine situation, again, this could shift at any time and in 1,000 different ways, but at least the market likes what it's hearing. We're still battling with inflation and interest rates. China is still going through their lockdowns, and we're still dealing with these inverted yield curve things. The economic reports that came out were by and large either ignored or pretty much taken as positive. We're currently overvalued still. If you look at the S&P by itself, when you do it, a comparison with interest rates and margin debt, we're more fairly valued right now. The trend is positive, and I did make a change here. We're seeing a slight turn up now with the ADX, and so that could signal a possibly strengthening trend that is an upward trend. Because we had the up day, our bias is positive, and the last number of days have been positive, so our momentum is also positive. And now I have to cough. Yes, I'm still battling that whole issue. So let's go through the day's session, see how things look on a sentiment level. We're getting more neutral and actually kind of tipping the scale into positive territory now, where we were slightly below 50. Well, with the advance on Tuesday, we're slightly above 50. And here is just the longer term chart to give you some perspective. The VIX is below 20 and continuing to fall, both on a closing basis and with the bar right here. So that just shows that extreme fear is really starting to wear off and getting in that, at least with the VIX, the 12 to 20 range, which is more neutral. When we're at the higher end of that, closer to 20, fear is still a little bit there. When we start getting down to 14, 13, and down to 12, that means that people are getting pretty complacent and they're not hedging a lot because they're just assuming the market is going to go higher. Well, we're not there yet. We're just dropping below 20, which just shows that there's not excessive fear right now. Also, the VIX continued to drop on Tuesday, both on a closing basis, and we saw a real drop in the bar as well. The Ulcer Index continues to drop because we are going higher. As far as the sectors, we had 10 out of 11 were positive on Tuesday, with the real estate, which had been getting hit hard kind of lately. And of course, tech had a good day. And a lot of the areas that were really getting beaten up recently saw some rebound. The one area that saw a bit of a decline was energy. That's been the strong area. So that fell back a little bit, while all of the other sectors have been experiencing, at least on Tuesday, a lot of renewed buying interest. And this is just showing you the different sectors right here, with energy well in the lead. And then communication is now in last place, with discretionary not far behind. So there's a lot of damage that still needs to be repaired from this. But when we get in and look at the chart, you'll see how it is improving slightly. Here's the tech sector, where we were able to get back above the moving average. We advanced over 2% on Tuesday, and the moving average is still going higher. So that bodes well, at least right now, for growth stocks. As far as inflation, and I don't have all the other aluminum and corn and gas, because they declined slightly, as did the CRB index, where we saw a 1.5% decline, but we're still in an overall trend. For the most, well, we're in a strong overall uptrend. And this is where a lot of the inflationary pressures are coming from. Our technical alerts, we had a lot of lists, a long list, and most of them are positive. Where you had the tech sector, they crossed above 80 with the BPI. The S&P crossed above 70, and I'll have a chart that shows that. Let's see, the S&P crossed above 4,600. Haven't seen that level, and at least stayed at that level for quite a while. The Nasdaq also showed some strength. The Dow, we were able to close above its 200-day moving average, and that's another signal that a lot of investors use. If we're above the 200-day moving average in the Dow, we are bullish. Below, we're bearish. Well, we crossed back above that. So you might have a lot of investors and traders who are really more positive now, because that's kind of the line in the sand, so to speak. And so don't be surprised if we see things stall a little bit. We might just scream higher. But again, we have to allow for all different scenarios at the same time. Canada has been bouncing back pretty well. The Nasdaq got above 14.6. And then with the decline in oil down below 105, that has helped, at least in the short term, with stock prices. Here's the intraday chart. We gapped higher. We gapped up right to R2. And then it's like, oh boy, here we go. Are we going to sell into strength? Because we never filled this gap down here. And it would have been more common, or not necessarily surprising, to see prices come all the way down to pretty much unchanged and then maybe take off from there. That's not what happened. We ended up bouncing between R2 and R1 for most of the day. Eventually, later in the day, we were able to break above that and close right at about the high. So it was a pretty positive day. And then here's the daily chart, which now we're showing this gap. At some point in the future, prices may come back down. And this could be tomorrow, it could be next week, it could be months, years from now. But there might be an attempt at prices coming back down to fill this gap that we're seeing in the index right now. But we did break above this short-term resistance right here, and even don't mind the size of these pink little areas here that I'm just using that to highlight. There's nothing magic about the fact that we're right near the top of this red box. That it has nothing to do with that, but it just shows that we not only broke through the double top, we were also able to get through a resistance level, a previous resistance level as well. So that's quite positive. We're down 3.44% from the all-time high currently, and growth is seeing more of an advance as value is seeing a decrease. And then looking at the indexes again to compare it, growth has really been suffering, but is starting to rebound. And value, which had really been advancing, is now starting to decline. The Nasdaq 100 also had a good day and is trying to repair some recent damage when it's related to the S&P 500. Here is the pure value index. It was up. So value stocks actually had a pretty good day, even though growth stocks also did well. So it was more of a broad-based advance. And growth stocks, well, let me see. Oops, I think I have the wrong chart there. Okay, I don't have the growth chart. I made a mistake on that. This is the ADX. This is where we see the dark line just turning up ever so slightly. It has not crossed the moving average yet. Now, the moving average I put on there, it's not part of the indicator. It just helps to determine trend. So we could see a positive trend developing as long as the green line continues to advance and or the red line continues to decline. This line has a great chance of turning up above 20, which then shows that we might be in a trend, and that trend could be positive. Or we might see prices stall a little bit here. The Arun is also quite positive right now. It's pegged near the top for buyers. It's declining for sellers, and overall the oscillator is advancing. We're coming off of that pring signal that still looks to be that was a good healthy signal that we saw there. Decision point, short term, both on their trend and PMO, they are positive. Intermediate term, they're more neutral to down. Long term, they are still positive with these are more mechanical signals that they generate. With the advanced decline, we saw a healthy advance based on price, and that's going higher. We're starting to see some improvement based on volume. It's coming right up to the moving average. The AD ratio is starting to get a little extreme positive right now. Market might be a little bit tired. New highs, new lows continue to advance. Accumulation distribution also looking pretty strong right now, but may in fact be getting a little far away from this moving average. Short term, we're well above the 20-period moving average, and both of these moving averages are advancing with the blue line on top. Here we have our moving average study starting to get a little extreme in the 20, improving and not quite extreme on the 50, and showing an advance on the 200. Moving average spaghetti tree, we're well above all of our moving averages now. MACD positive and advancing. STO going up based on price and volume. This is another concern. The McClellan oscillator is getting pretty far pegged into positive territory. The Stoke RSI pegged positive. Williams percent R pegged positive. Force index not necessarily too positive, but getting pretty high right now. Intermediate term well above the 50, still above the 100. That was one of the last things for the S&P that we had to cross above, and we did that on Monday. Well, we just continued with that on Tuesday. PMO advancing, both based on price and volume. The other PMO study getting a little toppy looking as far as the rising PMOs. The buy signals also looking kind of toppy, but hasn't quite rolled over yet. And those that are above zero continue to advance. We finally saw a bit of a breakout with the BPI, and this is where it went above 70. And that's one of the technical alerts that I referred to a little while ago. But now that we're above 70, this is starting to look a little extreme. Then here's the longer term view. We could go higher. We've done that before, but just be aware that it's in extreme positive territory. We're above the rainbow, and as long as we can stay above this rainbow, these moving averages will start to turn up. Stochastics, short term, really giving us an extreme positive reading. Intermediate term, also extreme, and getting pretty much in extreme territory now with the longer term or the full stochastics. Rate of change going back 10 periods, coming off of a pretty extreme reading. 20 days going back, we're getting close to an extreme positive reading. The summation index, positive and above zero based on price, and positive and above zero based on volume. All of our momentum oscillators are positive and might be getting a little extreme with some of these readings. Vortex, seeing a nice advance with the green line, that's buying, and a little bit of a sideways to slightly down move as far as selling. RSI, not getting toppy, at least yet. It is advancing and is well above 50 right now. The CCI 14 period turned back up slightly and is extreme positive. The CCI based on 20 periods is still extreme positive. Standard deviation. This is a little bit, might give you some comfort knowing that even though we're seeing a good solid up move, this suggests that we're not really going too far too fast. So that's another bullish point that we can take from this. But we have the Chaikin oscillator giving us an extreme, close to an extreme reading. The CMF also is advancing. The ultimate oscillator also giving us an extreme reading. Our trading systems, the Elder with the up day had another green bar to add. And here's the SPY also looking pretty positive right now. SAR, dots are below, so that is also positive. Our different charts, Heikin Ashi, lots and lots of open, clear candles here, which are positive. The Kegi advanced slightly, so that's positive. Renko, 3 open boxes, that's positive. 3-line break also showing some positive bars. The equi-volume is also, we're seeing a lot more green than red right now. Point and figure, we did add another X up here, so that signal that was generated, the double top breakout, it looks like that might be happening. Longer term, we are above the 200-day moving average, and that will help the long-term trend. Here's the logarithmic chart as well. The big mega stocks, they are really showing some improvement. They were able to get back above their 50-period moving average, and now we're back right up to the 200-day moving average. First, if we're going to stay positive, we'll need to break above this and then eventually see a golden cross, because right now we're still working off the death cross. Special K starting to advance, but still has a ways to go before it gets to the moving average on both charts. We're starting to get a little toppy with some of our moving averages. 50 getting a little extreme. We're still doing okay with the longer moving averages. The 150, that's still headed higher, and the 200 is still moving higher. Where we get concerned is when these start getting up to the red line. Broad market, here is the S&P showing a nice little breakout. Mid caps also were able to break out of the range. Small caps look like they may be able to be, they might be breaking out of this range. Sorry, I got distracted by the cat. Here's the Dow Jones Composite, which is one of my more newer charts. This is taking the Dow, the transports, and the utilities and putting them together as a composite average. And it was up over 1% on Tuesday. And we are seeing a positive cross recently. FANG stocks also up 1.44% and looking pretty good as far as the bar pattern here. Kathy had another good day. She was up almost 6.5%. So that might be starting to show the arc improvement. Then with our Dow, this is where we got above the 200-day moving average. And that's a big deal right here. The fact that we were able to get above it and then close above it is pretty positive. And then here is the diamonds, the Elder system with the diamonds with the up day. We've now switched back to a green bar. Small caps also were able to break above their 200-day moving average and maybe breaking out of this range, but there's still more range back here that we still need to break out of. Mid caps also were able to break above the 200-day moving average. So this was quite a positive day for things. Here we're looking at the Nasdaq hitting what could be overhead resistance, but also had a nice breakout. Then with the Nasdaq 100, it also was able to get back above its 200-day moving average. But we might be at some level of resistance right now. The Vixen saw a decline as the Nasdaq 100 has been advancing. Here's the QQQs with the elder system. We're still showing green bars currently. NYSE able to stay above the 200-day moving average and had a good day. It's not really breaking out necessarily, but it is still showing a lot of improvement right now. S&P 100 underperformed the S&P 500. So that means that on Tuesday, it was more of a broad-based, and we saw a lot of value stocks really advance on Tuesday. Wilshire also broke above its 200-day moving average. So we're seeing a lot of real positive technical things develop. And this is why I keep saying maybe people are now giving into this, because this 200-day moving average is a huge tool that is used very heavily. Internationally, we are seeing things really start to improve. Our all stocks were coming back up to the 200-day moving average and actually closed a little bit above that. World stocks, excluding US stocks, we actually saw a 0.42% decline with that. So it's mainly the US stocks that are showing a lot of strength right now on a comparative basis. Broad market, the dollar got spanked a little bit, but is still in an overall uptrend currently on the daily chart and on the weekly chart. It still is holding up fairly well. Here we have oil, which was actually dropped a little bit to 104.24. Gold, it looks like this was another fake out, at least to this point. This could always change, but we just have to go with what we see right now. And the ETF, even though it was up slightly on Tuesday, it's not really showing a very healthy pattern right now. And then here's the longer term view of the ETF. Silver also was actually down on the day, and after trying to have a bit of a breakout, has just been chopping around all over the place. But it's interesting how the 200-day moving average is acting as support. And then here's a longer term view of the ETF for silver. Bitcoin's trying to do a bit of a breakout. It's getting up to the mid to upper part of the 40s currently. As far as bonds, and this is, I'm going to be showing some more yield curve charts, at least for the time being, because everybody's talking about that, and we want to keep an eye on that. I look at these charts every day, but I don't always talk about them. This is the 10-year, 2-year yield curve, and it shows that we are declining and getting close to this red line. Then if we look at the 10-year to the 5-year, we've already gone inverted with that one. And then I included the S&P up above just to see, okay, well, when this happened before, well, prices just went up. Because one of the things that people are noticing is, okay, if we do go inverted, it doesn't necessarily mean you have to do anything right now. And a lot of times after the inversion happens and we go back looking more normal, we tend to see a pretty strong move with a lot of the indexes. Let me go back to this chart where we were showing an inversion in 2006, 2007. Well, we saw a pretty good run up after it went inverted the first time. We went inverted in 2019, according to this yield. Well, we ended up going quite a bit higher right up into the COVID plunge. So there's a case to be made for that too. Then looking over here at the 10-year to the 5-year, I thought we were already looking at that one. Okay, I'm still trying to get some of these things a little bit more under control here. And I don't want to stop and re-record this again, but this is also showing where we're dropping here. And then this is the one that is kind of the contradiction. This is the 10-year to the 3-month. And I was showing this a while back, and it's like, oh, it's not telling us anything. It's going the other way. Well, and that's part of the debate that's going back and forth, where we have parts of the yield curve that are starting to invert, where other parts are actually showing some strength. So it depends on what you look at. And that's why we are looking at as many of these as we can. Here are the yields, which saw a decline pretty much across the board on Tuesday. And then internationally, how yields are doing. And then the bond index that we follow, it continues to, well, it advanced a little bit, but we're getting down to some levels where we might be able to find support. But if we break down below this, that could really send interest rates a lot higher. And then the corporate bond index has seen a nice little bounce, but it's still in an overall downtrend. We're currently at 3.51% for the yield on corporate bonds. Junk bonds were up with stocks, but there's still a lot of damage that needs to be repaired. Our relative studies, gold, yeah, it broke down below the 50-period moving average. Now we'll see, is it going to come down to the 200-period moving average? Energy versus the S&P declined a little bit, but is still in an overall uptrend. Then looking at growth versus bonds, this is starting to break out a little bit. This is much healthier looking. It had been looking not so good, but now this comparative study has shown great improvement. And then here is tech versus the S&P. We're still coming back up to the 200-day moving average. Can we break through that if things are going to stay more positive? And then looking at tech versus the 10-year, it's actually bouncing a little bit, but still a lot of damage was done. As interest rates go up, that really influences tech stocks because they have to borrow a lot for a lot of this new technology and to just build their business. And then here is the 10-year against tech, which just shows that even though we declined on Tuesday, we're still in an overall uptrend with interest rates. Then comparing discretionary with staples, and I have another new chart I'm going to show here in just a minute, where we're still in an overall downtrend, but we're seeing an improvement right now. And this is the new chart. This is comparing the staples, the things that you have to have, with the S&P. And I was looking at this chart going, wow, this is kind of interesting. Look at where we topped out down below. And then look at what happened to the S&P. A lot of times when we had a topping out, that signaled some kind of a low in the S&P. Not always. And then a lot of times, well, I was looking at the bottom here. It should be that when we're topping out here, see, this was a bottom. Up here, this was a bottom. This was the bottom of the COVID plunge. This was the bottom that we're trying to come back up out of right now. So, and we're starting to fall back from that. So just something to give us some insight that you might find interesting. And then looking at the S&P against interest rates, where interest rates have been going a lot faster up than the S&P. So we've seen a real decline, but the last few days has seen a bit of a bounce there. And then looking at our low volatility stocks, they were up 0.93%. And then to compare them, the S&P is actually, well, the low volatility stocks have been outperforming, but are really falling back, with the S&P having a nice little rebound and potential breakout on Tuesday. And then this is another one that I'm going to start bringing up, is the CRB, which is kind of a real good inflation gauge against the S&P 500. And as the S&P was going down in early 2022, we saw the CRB really outperform. Well, now it is starting to fall back. And then I have just the inverse of that chart. where here's the S&P going down, but starting to bounce back overall, just to get us some more insight that we may not have had before. So our outlook for Wednesday, March 30th is we're out of correction territory and just within a few percent of our all-time high. We're still in that intermediate term range, and we will be until we either really turn around and go back down, which will put us back deeper in the range, or if we can break through and actually set another high. We were able to close above that short-term double top, which personally I see as a pretty big deal. Earnings season is coming to an end. There's still the battle between growth and value. That's why I show all the charts about that. There are the yield curve concerns, and those will probably linger for a while. But it's what the financial media likes to talk about, and it's easy to report, and it's easy to do videos about on YouTube, and it's easy to read a book or read an article and come to some conclusions. But then that kind of dies away pretty quickly as it happens. I remember back in 2019, we went inverted, and it's like, okay, and then the stock market took off and went higher, and I'm like, all right, well then there was a considerable lag, but then we hit COVID after that. So, and we're this whole yield curve thing is still playing out. We haven't really got out of that situation yet. So we don't really know when this is going to be over. But as far as being an emotional thing that people are talking about, that'll probably die away pretty soon. The Dow, again, was able to close above the simple moving average, which I had calculated based on Monday's close. Then economic reports. We've got a big one coming out. This is one of the GDP reports that is coming out. We're also getting the ADP employment change report. This is the precursor to the big employment situation report on Friday. And then the weekly MBA mortgage apps index will be coming out. And then just the same geopolitical events that we've had. I've taken the NATO meetings off there. They're still trying to figure out just what the US stance is in response to all of that. But again, this is a very fluid situation that's changing all the time. So what scenarios do we have? I added another one for negative. If you notice, and if you watch my videos for a period of time, when we're going up, I dwell more on the negative. It's not that I want to be, a doom and gloomer. It's when we're going up, I want to see, okay, what could go wrong with this continuation of going up? When we're going down, then I focus more on the positive. So it's just a skill and a tactic that I've used for a long period of time that I hope that you will also find useful. But are we going to revert back to the previous trend? This is looking less and less likely. In fact, if we still continue much higher, I might even take this off as a possible scenario. But what is more viable is that we are in a short term, we're overbought with some resistance over, mainly some of our indicators are starting to look a little tired right now. We do have rising interest rates and yield curve concerns that if that starts to get real crazy, that could really push stocks lower, as we saw last week. And then this initially was a positive thing, but a part of the reason why I think the market has really rebounded nicely was a disbelief that it was really going to happen. Well, after we've crossed above the 200-day moving average, that's turned into belief, and that could actually be negative. When you get a whole herd of folks all going positive now, the herd tends to arrive late to the party. Could be wrong. We might still have some more room to run up, but just something to think about. Positive side, yes, we're coming out of that base. The oscillators are positive. The moving averages are pretty much providing support now. And we were able to close above the short-term double top. And then also disbelief turning into belief. There's still a lot of people that are skeptical about this bounce. You get the people that are doom and gloomers all the time. And you look at any one of their charts and they're always drawing a down arrow to the end of the world. You also have the eternal optimistic folks that always think that there's going to be bright days ahead. I prefer to be right in about the middle and try to be a realist as best as possible. And then we may, if we start to go sideways and slow down, we may get more into a sideways pattern because the ADX could still drop below 20, but that doesn't necessarily seem viable at this point, but that could change. So our conclusion is that the S&P is positive and could be breaking out of a range. Short term, we are positive. We're showing a lot of overbought signals though, and also some other areas of resistance. Intermediate term, we're also positive with our oscillators being positive. The moving averages are pretty much the ones that I use would potentially be areas of support right now. I'm mainly referring to some other indexes here. Long term, as long as we're above the 200 simple moving average, the long-term trend continues to improve. So thank you. Have a really good day, and I will talk to you again after Wednesday's session.